So it's the last trading day of the first quarter of 2012. Anything that really stuck out for you over the last quarter? Of course, the bond auctions being, of course, top of the agenda over the past while.
Well, I mean, it's been an interesting quarter. I mean, at least rates have started to trend down, which definitely is positive for the overall market, particularly if you're somebody who wants to come to the market to raise money. The equity side hasn't done as well as you would have thought it should have done. But again, it's only one quarter. First quarter is not always where all the action is.
Okay, so this week we saw a DMO auction coming through with regards to the bonds that were issued. We're looking at yields of just over 15%. What is your sense with regards to the stabilization of the bond yields and also the auctions that we've seen?
Well, I mean, this is the third auction of the year. Rates have progressively improved. At least the trend is definitely down with 15.3 and 15.41 on 2019 and 2022. Secondary market also points to that direction, most pricing between 15.2 and 15.4. So if this trend continues, we should probably break below 15 in the next month or two. And then it becomes really interesting for those who want to come to the market to issue new bonds. The timing that DMO has introduced to time their auction with the FAC allocations, the federal allocations, seems to be working. I mean, I think it seems to be showing that if there's not too much CBN activity with the open market operations taking money out of the system, then some of that money will find its way to the DMO auction and push rates further down.
Speaking of the DMO, I mean, looking at some of the positive rhetoric that's come through with regards to the $500 million Nigerian euro bond, it seems that other banks are expected to take cue from this. Is it better to source capital from inside of Nigeria, or is it better to actually look at that euro bond? I mean, you've obviously got to compare the yields, and this is what the big factor will be.
Yes, I mean, we've been hearing a number of banks talking about going offshore, following the leader GT, who did $500 million last year. I mean, for those who are issuing bonds, I mean, GT and UBA and Sterling have done local bond issues. When you do those local bond issues, you're pricing above FGN and you're ending up with rates that, compared to your dollar rates, look significantly a lot higher. For dollar rates, most of these banks will be around B+, B-, and issue around 7% in foreign currency. In Naira today, they'll be issuing at least 15% plus. So that big differential will make some people go foreign. Also, it's about capacity. $500 million transaction is roughly about 78 billion Naira. Nobody has successfully done a local bond of that size. Certainly not any corporate. The highest so far as I know, is 37.5 billion. That was Flour Mills in 2010. So really, if you want to raise significant amounts of money quickly, the best option right now is foreign. But of course, you need to have a way of deploying that foreign money immediately, because you start to pay coupon from day one. And when you're paying coupon of over 7%, you need to have very good quality transactions to deploy this money into.
Let's also, I mean, are you concerned about the debt levels coming through, not only from the private sector, but also with government as well? It seems that these auctions are occurring quite often. Are you concerned that we might just be sitting in a scenario of over-indebtedness?
Well, I mean, again, there are different arguments about the level of debt that can be sustained. I think debt to GDP in Nigeria is slightly under 20%. I think if you add all the tiers of government together, it's a tricky question. I think one simply has to look at the trend. I mean, in this auction this month, it was 50 billion auction, but there's another 50 billion that was issued on a non-competitive basis. That's the second time in 3 months that's happening. So if you keep having a lot of these extra auction issues going on, we could end up in a situation where we issue more this year than last year. And if the trend is up, then there might be a bit of cause for concern. But so far, I don't think the levels are that high compared to most other countries in the same cycle as Nigeria.
Well, the truth is, I mean, apart from Ondo State, we haven't actually seen any other states coming to the fore with a bond auction this year so far. What is your expectation going forward?
Well, I mean, Q1 is typically not an active period for state bond issues. I mean, if you look back the past few years, anything you see in Q1 is a spillover from December, like was the case in Ondo State. You start to see the activity from the end of Q2, and it tends to coincide with quarter ends because of the accounting rules around how these transactions are done. So definitely this year, I would expect to see significantly more than the 92 billion on the state side from last year. Corporates is not as definite. I mean, simply because borrowing rates are very high and the high quality issuers are still getting bank loans below the federal government rates. But when it comes to states, there are probably 8 to 10 states that are at various stages of their bond issue process. Definitely some of them will close this year, and we should be looking at close to about 200 billion plus or minus raised on the state side. But this is all subject to interest rates. If interest rates remain at this level, we might not see that 200 billion number hit. But if rates can come down, maybe about another 1% from here, then you could see a significant number of issues come to the market.
So, Egie, if you could also just give us a forecast into the rest of the year. Are you expecting this to be an overall positive year? And I think we've spoken on this quite some time when we talk of the pension funds now being able to allocate half of their portfolio to equity markets. We know that there has been a big tug of war between the high yields that we see within the fixed income space relative to what we see on the equity front.
So, well, in terms of the outlook for the year, again, if these rates do trend down as we expect they will, then once they start to come below like around the 14% level, then there might be a bit of attraction for the equity investors. The dividend yields on many of these equities are significantly higher than they used to be, and it's getting to the point where if you're seeing a dividend yield of 10% or close to that, then you know that you only need a 5% upside in the price to match a fixed income investment, and then it could look a bit interesting on the equity front. But for now, the yields on the fixed income are so good that it's not as attractive to go equity for today.
Fantastic, Egie. We have to leave it there. Thank you, sir, and I hope you have a great week.